REITs are dropping. Should we be buying? I'm going to focus on Realty Income Corporation, A, because I hold this in my portfolio, but B, this is a very popular REIT amongst investors, so I want to provide my analysis on why I'm buying, and this video will provide you some great information for your consideration on Realty Income itself and other REITs in general. So let's start by looking at my portfolio performance because something interesting is happening here. Now, I was up about 13%, so it's dropped a little bit. Interest rates are the worry with the economy that the Fed will keep having to raise rates or keep them higher for longer. So therefore, things are going down in the market, specifically REITs. And you'll see on the top right, both VICI and Realty Income are now in the red. They've been in the green for a while. So this is, to me, presenting an opportunity because I think these are both high quality REITs, and we're gonna go over this. Now, before we go over more in the video, I do want to offer you guys an opportunity to earn $100, and I have Ally Financial and I utilize a high yield savings account, which now gives 4.25% interest on your money, which is great. And if you use my link down in the description and you sign up, open up an account and fund that account, you get $100. And again, you can open up a high yield savings account and earn 4.25% on that money that usually sits in other big banks savings accounts that earn 1 or 0.1, whatever it is. It's very small. You're losing money in those accounts. At least you'll be making some good here. So it's the first 5 people that signed up. I'm not sure if anybody has because I introduced it in my last video. But regardless, just getting that high yield savings account is great. But if you can get that $100 free as well using my link, even better. So let's move on. Realty Income. Right now, their dividend yield is hovering around 5.3%. That is very attractive. Anytime VICI or O go above that 5%, or maybe REITs in general, I think it's an attractive thing that I want to look at and see if it's time to buy. So should we buy? We're going to take a look at a lot here. We're going to start with the recent earnings. So this is going to compare the 3 months ended on June 30th and the 6 months ended on June 30th as well. So 3 and 6 months. If we look at the revenue, it's gone up in both scenarios, which is great. Of course, expenses have gone up as well. I mean, interest rates are rising, which is making the cost of everything virtually go up. So not a red flag here, very normal. All companies are basically experiencing this. Now the net income, when it comes to the 3 months ending on June 30th, comparing the years, it did go down slightly. But if you compare the 6 months, it was virtually flat, a very slight decrease. So to me, this is all positive. The thing you want to look at with REITs is the adjusted funds from operations. We're going to go over this a little bit more in detail, but this is increasing and that's a very good thing, and I'll tell you why in a little bit. Let's look at the portfolio of Realty Income, kind of the high overview. They own or hold interests in over 13,000 properties. They lease to over 1,300 clients doing business in 85 industries. To me, this signals a REIT that is well diversified. That's what you want. That's that level of safety. Now, at the end of June 30th, 2023, their occupancy rate was 99%. That is fantastic. And a year ago in 2022 was at 98.9, so a slight improvement. And they always hold at about that 99% range. So to me, that's just fantastic, as well as they had 99% rent collection. So again, just to me, this signals high quality. Now, every time that there's earnings, usually a company gives guidance. So right here we have some guidance. We have the prior and then the revised guidance. For net income per share, it was reduced by 2 pennies, which to me is not a big deal. That's barely a budge. Now the AFFO per share just narrowed the range. So it became more accurate, and I like that. So it raised the bottom end by 2 pennies and the top end down by 2 pennies. So it just narrowed it down. Now the acquisition volume, they're changing it from over 6 billion to over 7 billion, so they're acquiring more, which to me is great. That's them being able to expand because they have the means to. Now, AFFO, let's talk about this. Adjusted funds from operations, it's a more precise measure of residual cash flow available to shareholders and therefore a better base number for estimating value. It is true residual cash flow and a better predictor of the REIT's future capacity to pay dividends. That's why we mainly invest in REITs. Now, the equation for AFFO is taking the non-adjusted funds from operations, you're adding in the rent increase, you're taking out the capital expenditures, and taking out routine maintenance amounts. And this is really painting a really accurate view of the financial performance. So let's look at some stats regarding their AFFO, FFO, and even the net income that's available to common shareholders. Now, the more that they have of AFFO, the greater the increase, the more cash that is that they get to put towards those dividends and other things of their business, of course. But the net income, we're going to look at 5 years because we're going to do some comparisons. This is going to help us look at the performance and see where they're at as far as valuation. But their net income available to common stockholders has more than doubled over the last 5 years. Their FFO and AFFO available to common stockholders has almost tripled. So what we're seeing here is great measurements over the last 5 years of increasing AFFO, which is something we want because, again, that's their capacity to pay those dividends. And so to me, I don't worry about their dividend, not with Realty Income. Now, if we look at their stock performance since 2019, since we're going back to that time frame, we'll see they're down 18.28%. So it hasn't been performing well, but we've seen good revenue increase. We've seen the AFFO increasing. Let's see what else might be going right or wrong. So let's look at their balance sheet. First off, their cash and cash equivalents is going up. That's a good thing. But more so, their total assets is going up at a higher rate than their total liabilities. And that is something that is really good to see because here in a minute, I'm going to explain why. Let's look at the profile of the company in more detail. Specifically, let's start with the top 10 industries they're in. Right now, the top 3, I believe, are the most recession resistant, if that's your concern: convenience stores, grocery stores, and dollar stores. I also think drugstores and quick service restaurants are recession resistant. And you'll see home improvement, I think, will stay pretty steady. I think all the home buying that went on over the last 3 years is just going to create projects for some time to come. So I think this is a good diversification of the industries they're in. If we look at the top 20 client diversification, I as well think this is great. They have recession-resistant businesses such as Dollar General, Dollar Tree, Family Dollar, 7-Eleven, Sainsbury, which is a grocery store in Europe, if I'm saying that right, Walmart, Sam's Club. You have also like a CVS, Walgreens that I think provide some strength in that area too, not as good as the others. So now let's look at the property type diversification. We'll see they're mainly in retail, they're heavily concentrated there, but it's also diverse within there. So you got to look beyond that, as we just saw. They're also into 13.1% in his industrial property type, and now they're new to gaming, which I'm very excited about. We're going to talk about that here in a second. The top 7 regions, they're really wanting to expand in Europe. That's, I think, their next area of growth. So that United Kingdom is on the top there. And then the others are the states of the United States. So Texas is a huge one, California, Florida, Illinois, Massachusetts, and Ohio. I think they all offer different strengths and are good states to have properties in. So now let's talk about the gaming. In 2022, Realty Income purchased the Wynn Encore Boston Harbor Resort. And how they did this is under a 30-year triple net lease, which is very favorable because it includes an annual rent escalator linked to CPI. That's very important. Also, in 2022, Massachusetts legalized sports betting, and in 2023, this hotel launched in-person sports betting at the Wynn Resort's WynnBET Sportsbook. Also, this hotel, this casino holds one of only 3 Class 1 gaming licenses that have been granted in Massachusetts. So a high quality gaming property that Realty Income purchased, and I really like this. I like that they're diversifying. I also have VICI, which is an experiential REIT, which has a lot of gaming facilities, especially on the Vegas Strip. They've done very well. And talk about, if you're worried about a recession, VICI was able to collect 100% of its rents on time during that whole pandemic. And so I think that's the value and the benefit of investing in quality gaming facilities, which this is one. And so I think Realty Income is doing a great thing here. They're diversifying and also now going into an area of growth. So why has Realty Income stock underperformed over the last 5 years? Well, REITs are sensitive to changes in interest rates. Publicly traded REITs have the risk of losing value as interest rates rise, which typically sends investment capital into bonds. And we've seen a lot of that. The other thing is REITs usually carry high debt. They are highly leveraged, and that's just how they work, as it takes a lot of money to buy properties. So many REITs in high interest rate environments can pay a lot of interest on that debt, and therefore that can negatively affect financials and the company unless their debt profile is strong and they have other strong company fundamentals. So speaking of that, regarding Realty Income, if we look at their debt to equity ratio, we'll see over the last 5 years, again, we're looking at a 5-year trend, it's gone down pretty significantly. Now, the debt to equity ratio shows how much debt a company has compared to its assets. So yes, their debt is increasing. If you look at Realty Income, you will notice that. but so is their shareholders' equity, and enough to create a decline in their debt to equity ratio. So basically, its assets are growing faster than their liabilities, which we are seeing on the balance sheet, and that's a great thing to see, and it gives me very much comfort in the debt that they're holding because they're doing it very responsibly. This company is very disciplined. Now, another thing to mention here with the high interest rates that could be a positive is it could mean higher rents that they can collect, and also occupancy rates will remain high because businesses are less likely to move during these interest rate times, the environment that we're in, shall I say. So for all those things, I see an opportunity here. Realty Income is positioned well to weather a storm. It's diversified, established, has a 99% occupancy rate as well as collection rate. They have a portfolio of recession-resistant businesses, as well as businesses to benefit off of good times that people will spend more money on. But really, it's that protection that this company is offering. And speaking of that, if we look back to the Great Recession, Realty Income exhibited the lowest operational and financial volatility versus A-rated S&P 500 REITs. You'll see here on the very left, there's a ranking 1 to 8. 1 is less volatile, 8 is more volatile. And Realty Income, they're highlighted in orange, stayed in the top tier in most of these measurements in rental revenue, gross margin, EBITDA margin, and unsecured debt, total debt. The debt to EBITDA was a number 2, which is still less volatile on that range, as well as the occupancy rate dropped, but it's still in the top 4. So really, this is showing that they can withstand a recession very well, and they probably learned from this. So a future one with them being even more diversified than before and probably learning from things, I think this company is very solid and safe. We can also look at how historically the cash flows, there's been a lot of stability with it. You'll see in orange is Realty Income, and in blue is the S&P 500 REITs collectively on average, and Realty Income remains above. And that's because this company is run with discipline and with a conservative approach, sticking to their plan, and it just all pays off. This is a very good thing to see. So Realty Income is a quality REIT, and the increase in the interest rates is causing investors to ditch REITs. But interest rates won't keep going up forever. I think people forget that. They get stuck in the view that's right in front of them, and they don't look beyond that. They will come down at some point, and then what do you think will happen to REITs like Realty Income? Investors will start flooding back in and push up share prices. Now, low-quality REITs you want to avoid, as there is a greater risk of issues related to their debt, concentration, and low interest from investors. But those of high quality like VICI and Realty Income with good management teams, wide moats, solid financials, and more will race these stocks back up eventually, and I am here to face the fear others have in these REITs that I have high convictions in. The greed will be back along with higher valuations, so that's why I am buying now until the Fed signals rate reductions and we start to see the fear move away from REITs. So let me know if you agree with my analysis on Realty Income, and do you think this is a buying opportunity right now? And let me be very, very clear. I'm not saying I'm dumping in all my cash into VICI and Realty Income, but rather I'm buying moderately each paycheck to increase my position in Realty Income. The interest rate environment can get more unfavorable for these REITs. We just don't know at this point. So I'd rather average in over the next month to a year, whatever the time frame may be, until we see a positive pivot when REITs start to benefit. And at that point, I will slowly reduce my buying until I feel valuations are too high again. But I think the opportunity starts now for capturing a great yield and for buying at low valuations in quality REITs. Again, be sure to take advantage of that Ally cash offer, link in the description. It's $100 you get. And I appreciate you for watching, and we'll see you soon on Mark Arnold's Finance.